If your mortgage is coming up for renewal, like mine is in the next month, you're going to want to stick around and watch this video. I'm going to go over all considerations that I am making when it comes to my primary residence mortgage. This is not for investment properties. This is for primary only. I'm going to go over all considerations that I'm taking into account when making this decision. And I'm going to walk you through the math as well as my Excel model and a couple of assumptions that I'm making into the future. I think you're going to find this helpful. This is not going to be financial advice, so take it with a grain of salt, please. But I will at least show you what I'm thinking out loud, and that hopefully gives you some sort of an idea of how to consider your mortgage renewal situation and what to do. My name is Vas, and I'm a real estate broker right here in the city of Toronto, where I help families and investors navigate the insanity of our real estate market. Now let's get into this video. If this is the type of content you want to see into the future, please like this video and subscribe to the channel. It gives me the feedback I need to know what you want to see going forward. Now, let's talk about just variable versus fixed for a second, because this is an important point. There is no right or wrong way to pick your mortgage. Personally, I think it comes down to your risk tolerance and what lets you sleep at night. So for me personally, for over 10 years of taking on mortgages, I think only once I've taken a fixed rate mortgage. Predominantly, I've always taken variable, and I'm okay with it. For me, it really comes down to the pennies and the dollars. I think historically, variable has almost always outperformed fixed rates. To the tune of like 70 to 90% of the time, variable is going to be cheaper than fixed. Now, that is not to say you have to go out there and get variable. Like I said earlier, you have to do what makes you sleep at night. Some people cannot deal with the stress or the anxiety of potentially variable rates going up and their payments going up. So if that is going to leave you sleepless, forget variable, go fixed, take the sure thing, and just move on. Now, as far as the market right now, as far as interest rates are concerned, it seems like we've topped out in terms of rate hikes. We may have another 1 or 2 hikes potentially, but they would probably be 25 basis points at most each. And then it's really a matter of duration. How long are these sustained current high interest rates going to be around for? And there are a number of ways to look at it. The experts typically look at the 10-year and the 5-year bond yields to determine when the market or the experts are pricing in rate cuts. So with that said, here's a really nice chart from wawa.ca, which basically goes over when they expect the rate hikes to come in the future, and then when they expect rate cuts. As of right now, there's a probability of a rate hike of 27% in September. I know a lot of people chatter online as well, pretty much assume that in September we're going to have a rate hike. The experts are saying 27% of that. They're really expecting another rate hike in January of 2024 or potentially December of 2023. In my model, in my assumptions, I'm just going to take the conservative approach, and I'm going to assume we're going to have another 25 basis point rate hike in September. And that's how I'm going to model whether or not I'm leaning towards variable or fixed in the short term. Also, what I've done is I've taken all of these probabilities in terms of rate cuts. So for example, the first rate cut that we're expecting is in July 2024, and then a few additional rate cuts going to December 24. I will plot this entire thing into my chart. We'll see how the rates average out, and we'll see how much one is better than the other. So Bank of Canada rate forecast for 2024 and 2025, bringing policy rate back to neutral. So this is all based on inflation numbers. Once we get a control of inflation, where is the rate going to end up? So I found this pretty interesting. I'm going to model my Excel model behind this. So with inflation under control in a weak job market, assuming 2024, we anticipate that the Bank of Canada will gradually lower its policy rate toward the neutral level. We expect the policy rate to reach 4.25 by the end of 2024 and 3.25 by the end of 2025. Whether or not this happens, I don't know. Does it happen earlier? Does it happen right as per this forecast, or does it happen later? I don't know, but I need to anchor to something. I think to me, this personally sounds kind of reasonable. So I'm going to model my Excel model behind this data and see what happens. Now, here's one part that a lot of people are not talking about that I think you need to pay attention to, because this really will impact variable rate mortgages. And I think it's an important one and a material one. So typically between the Bank of Canada rate and the prime rate, there's a spread. And that spread right now is, I think, 2.35% as of the recording of this video, which is based on volatility and risk. Let's call it the risk premium. So whatever the banks offer as a prime rate, that's going to have a built-in risk premium relative to the Bank of Canada rate. So right now, the Bank of Canada rate is 5%. I think TD Bank's prime rate, for example, is 7.35. So the spread is 2.35% at the current moment. So what does this mean? So it's important to take into consideration that right now that spread is pretty high. Typically, based on historical data, if I look here in the past, usually the spread is about 2%, not 2.35, but around 2. So even after the financial collapse or financial crisis in 2008, the spread was even lower in some cases. less than 2%, but usually it seems to have been averaging about 2, and now it's at 2.35. I think this is also important to consider because we could be seeing a decrease in the spread, which is also going to further reduce variable rate mortgages into the future. Obviously, this is an assumption. We don't know if it will happen for sure, but it's something that we'll need to model to understand what could potentially happen that favors variable rate mortgages into the future. All right, let's get into the fun stuff. Said no one ever when you look at an Excel sheet, but I'm going to go through this quickly. I'm going to try not to bore you to death. I'm just going to go over the basic assumptions. So rate change, this is based on the forecasted rate increases and then following rate cuts in 2024 and 2025. Prime currently is 7.35 based on my last check with TD Bank. The spread between Prime and Bank of Canada is 2.35. We'll talk about that in a little bit. And the current 5-year variable rate that's available is about 6.45 or prime minus 0.9. Now, it's important to note this is for uninsured mortgages. If you have an insured mortgage, you can get prime minus 1.2 as of the last time I talked to a mortgage specialist. And these are the commonly available fixed rates. So 2-year fixed 6.84, 3-year fixed 6.19, and 5-year fixed 5.74. Let's say you want to compare, you're considering taking on a 2-year fixed and you want to compare how that plays out versus taking on a 5-year variable over the 2-year period. If you take into account this rate increase in September, which is really more scheduled to be towards the end of the year, but let's be conservative, assume it's going to happen in September, and then these following rate cuts towards the end of 2024 because of a slowing economy and so on, we're averaging a variable rate over 2 years of 6.17. And remember, our 2-year fix currently offered is 6.84. So we can save roughly 0.67% if we go with a variable and this forecast right here with these rate cuts plays out. Now let's take a look at how variable compares to a 3-year fixed. So no big surprise here. So the average variable rate over 3 years works out to about 5.7%. The 3-year fixed is 6.19. So the difference here, variable rate will technically save you about 0.5% annually compared to the 3-year fixed. Now, no big surprises here. Anytime you're taking on a fixed rate mortgage, obviously the bank is going to be putting in an insurance premium in there where they're making money for giving you the safety where you know exactly how much your payment is going to be over the term of your loan. Now, if you remember, I talked about the spread between the Bank of Canada rate and Prime, and there's a risk premium in there. So right now that spread is about 2.35%, and like we looked historically, it usually hovers around 2%, and usually after a recession or the financial crisis it was actually 1.75%. And the reason it's important is I modeled this exact same thing but with the spread between Prime and the Bank of Canada rate being 2%, because that is likely on the table too. So if we have rate cuts in the future, that is one win for variable rate holders. But in addition to that, we may have a lower spread between Prime and Bank of Canada rate. So let's take a look at those savings. So again, the model is exactly the same, except I have made 2 adjustments. So towards the end of or the middle of 2024, we expect the spread is going to drop from 2.35 to about 2.1 or 2.15, and then it's going to drop again to about 2% in early 2025, which is again a material win for variable rate holders. And I think this is not out of line. It's actually a pretty conservative assumption in my opinion, which leaves us with variable rate holders will be ahead by 0.82% compared to those taking on a 2-year fixed. And if you look at the exact same thing for 3-year fixed versus variable, we're looking at a win of about 0.71% if you take on variable. Again, I want to reiterate that this obviously comes with its own set of risks. And if you need fixed rates to sleep better at night, then that's probably what you should be doing. I'm kind of just going over how I'm thinking about it strictly from a numbers perspective. Personally, as of right now, I'm strongly considering taking on another variable rate mortgage when my renewal comes up. Obviously, I'm not sure what I'm going to do. I still have about a month to decide. But that is where I'm leaning. And as you can see, this is the math I'm working with. I'd love to get your feedback. And if you have any questions or concerns, please email me or text me.